All right, hello and welcome everybody. It is time for us to do Chapter 11, Part 2 of Murray Rothbard's America's Great Depression. Now, this is starting from the lower part of page 301 in the 5th edition that I have here, the one from the Mises Institute. And we're starting with the section of the chapter called The Inflation Program by Rothbard. And so last time we talked about a lot of different things that happened in 1932. Today we're going to be mostly talking about inflation. That's probably about 2/3 of what we're going to be dealing with here. And then a little bit about a couple other little things at the end of the chapter. I'm not sure why Rothbard structured it this way. Like, if it were me, I probably would have taken all the inflation stuff and put it either at the very beginning or at the very end. But this is what we've got. And I wanted to kind of keep things in a chronological or as written order for you guys so that you can use it as a study guide as opposed to having me jump around like crazy. So, without further ado, let's get started. In 1932, Hoover was interested in more inflation, and a lot of people were, in fact. In February, the Congress passed the Glass-Steagall Act, and what this did is it made more assets eligible for rediscount. That is to say, having notes against them being re-loaned at the new lower rates. The other thing that happened with the Glass-Steagall Act that is very worrying, or at least it should have been, was that it gave the Federal Reserve the ability to use government bonds as collateral for notes. It basically started the Fed on its, government bond buying, madness that it continues to this day. The Secretary of the Treasury, who was Andrew Mellon, who was not really a conservative, but at least was not, full-on Keynes 100% spend more, was replaced by Ogden Mills, who was much less attached to caution. They started a massive program of buying government bonds that lasted through the first half of 1932. They did $660 million in less than a year. Yikes. So Rothbard says at this point that in order to understand this situation, you really need to split the year into two parts. One part starts at the end of February and goes through the end of July, and the other one goes from there to the end of December. In that first half-ish of the year, the total reserves rose by $213 million. There was bond buying in this period that amounted to $1.1 billion in just 5 months. There was a $200 million decrease in bank debts to the Fed, a $380 million decrease in the gold stock at the Fed, and a $122 million increase in bills in circulation. Now remember, bills in circulation mean that they're not in deposit anywhere, which means that they're technically a decreasing effect on the money supply because the banks can't loan out that value. In the second half of 1932, after the end of July, banks started to increase their reserves over the minimum necessary amount. Up until this point, they had largely stayed loaned up all the way. But at this point, they broke that, pattern, and they started basically holding on to more reserves than they needed to. What Rothbard says this signals is that it was a sign of falling confidence in the economy. And it was also a note, and he also notes that the gold withdrawals from the reserve system forced the money supply to reduce also. Basically, the Fed tried its best to inflate, but forces that they did not control basically outdid them in the deflationary aspect of things. There's a common explanation for the bank's actions here is that, the demand for loans went down because, we were in a depression. There was fewer opportunities to loan things to good businesses. However, Rothbard notes that banks always could buy existing securities if they wanted to. Therefore, the reason for these excess reserves must lie somewhere within the banks and not elsewhere in the economy. At least that's Rothbard's argument. Now, banks are typically reluctant to lend especially in a depression, for two reasons. Number one, they want to avoid endangering customer confidence. And number two, they want to avoid the risks of lending to ventures that might end up defaulting, right? And in the case of a depression, both of those risks are higher than they otherwise would be. But there's something that people usually don't talk about that Rothbard points at that is very important. It is that lowered interest rates also discourage a bank from actually lending because there's less for them to gain by lending at this lower interest rate than if they just held onto it and put it in something very, very safe. Risk is one of those things where it is certainly possible that there will be a default at some small percentage, and it's very hard to measure that small percentage. And when it's very hard to measure that small percentage, it can be, just like, screw it. I'm just going to put my money in gold or in something that doesn't have any risk to it and just let it ride. And banks are vulnerable to this, what would you call it? I guess you would call it like a habit of mind as well. Oddly enough, this is the first chapter in which Rothbard actually mentions bank failures. And what we see is that he should have mentioned them much earlier, and I don't know why he didn't. But here's where it happens. In fact, I'll give you the page number. It's over here on page 304. So, in the 1920s, during the boom period, it was typical to have about 700 bank failures, amounting to about 170 million in deposits per year. That sounds like a lot of banks, but you have to remember that back in the day, it was not possible for banks to have branches. And so it was more difficult for banks to kind of spread that risk out over a larger area. That said, we have these numbers from the 1920s, and it's kind of an average, a per year average. In 1930 alone, there were 1,350 failures, amounting to 837 million in deposits. In 1931, there were 2,293 bank failures, amounting to 1.69 billion in deposits. And in 1932, there were 1,453 bank failures, amounting to $706 million in deposits. Now, these three numbers are all significantly above the typical numbers for the 1920s. And you'll notice the number of dollars in deposits are much larger on average, or per bank, than they were in the 1920s as well, which means that larger banks were also failing. Another thing that prevented the inflationary efforts from working was that what happened was that foreigners started withdrawing their gold from the American system. As I mentioned earlier, Americans withdrew Federal Reserve notes, which prevented banks from loaning those out, and bankers also contributed by basically using the extra money that they were getting from the Fed to pay off existing debts to the Fed. There was actually a little bit of deflation from July 31st from July of 1931 through July of 1932 because of all these uncontrolled things reducing the money supply, even though the Fed was going crazy trying to inflate as much as it could. Was this the cause of the summer uptick in the economy in 1932? Well, Rothbard notes in footnote 25 that while this 1 year of deflation was 3.3% per year, per annum, that in the 1920s there was 7.7% per year inflation on average. So probably not a big enough deflation to make that huge of a difference. In the second half of 1932, the security buying rush from the central government, or from the Federal Reserve buying stuff from the central government, ended, and some deposits started to flow back in because there was this small summer uptick. But the main problem was these excess bank reserves. Seymour Harris wondered in a publication, like, man, we've already had so much liquidation, is it not enough? Like, he was basically saying, we would expect this reflation to work if all the bad businesses had been liquidated. But as we've seen from earlier in the book, Herbert Hoover and his government were trying their hardest to make sure that businesses did not liquidate that when they needed to. And so, this is something that Seymour Harris was like, man, we need more liquidation after all this. Well, you keep stacking more and more malinvestment on top of existing malinvestment, and you need more liquidation. There's a lot of PR going on in this period. Herbert Hoover ranted publicly about traitorous hoarding, quote, traitorous hoarding. There was the Citizens Reconstruction Organization, which had its own PR campaign. On page 307, there's Hoover talking about money like money is wealth, which is not true. It's a fallacy. In fact, partly because of this PR and partly because of the minor uptick in the economy in the summer, it seemed like the hoarding stabilized until about February 1933, where then it started to get worse again. What this actually did was it postponed and intensified problems in banking. There was a lot of anti-bank public relations going around too, basically saying that these banks holding on to these excess reserves are preventing the economy from doing its thing, and therefore we need to, bully these banks into spending all that excess money on random businesses that might fail. Fortunately, Hoover's efforts at bullying banks into doing stupid things largely failed, is what Rothbard notes. Now, I've been talking about inflation for about 10 minutes, but we're not done yet. The next section in the book is called The Inflation Agitation, and it's mostly about the people trying to get the government to inflate more. So this kind of attack came from many, many different directions. There was a proposal from silver advocates to set up a bimetallic standard, which of course would make their silver more valuable. There was a lot of efforts toward stabilization, but what Rothbard notes is that stabilization actually meant not stabilization, but reflation to pre-depression levels and then stabilization. And it's one of those things where if you understand the Austrian business cycle theory, you understand that the inflation was the problem. It created malinvestments. We can't just put those malinvestments back because they are, in the end, unprofitable and they need to be liquidated. But of course, nobody was listening. Irving Fisher, the Stable Money Association, the Committee for the Nation, there was a thing for soldiers' bonuses, there were ominous proposals for a fiat money standard. All these people were crying out for more and more inflation. Once we inflate back, then we can stabilize. And we're going to call that stabilization. There was an important bill called the Goldsboro Bill, which later became the Fletcher Bill, just so you know. The goal of the Goldsboro Bill was to reflate to pre-depression price levels and to give the Fed the power to raise or lower the gold weight of the dollar. And, we all know at this point that just means lower it, right? Like, we're not in that crazy fantasy world where we believe that the central bank is actually stabilizing anything and not just, shaving things off the top. Okay, good. This bill passed the House, surprisingly. This is despite the fact that it was opposed by a variety of different groups. The New York Merchants Association, the Commercial and Financial Chronicle, and even some Federal Reserve authorities were like, this is a bad idea. We shouldn't do this. But wildest and worst, according to Rothbard, were these barter schemes for the unemployed. Basically, take the unemployed off of, out of a monetary economy, out of economy with media of exchange, and just have them barter, which obviously makes the problem a lot worse. There's a reason why even the most primitive man got away from barter almost as soon as he possibly could, to the extent that he could. This, surprisingly, perhaps, this got backing from many different famous economists and high officials, which is surprising, but at the same time not surprising. Let's see, at the University of Chicago, there was an Institute on Gold and Monetary Stabilization, and remember, stabilization does not just mean stabilization. It means inflation followed by stabilization, and the inflation is the problem. They recommended a bunch of crazy stuff. For instance, they said, oh yeah, definitely pass Glass-Steagall, that's a great idea. They said, the Federal Reserve banks should buy more securities. That's fantastic, that's exactly what we want. Fund more, wasteful public works. They wanted the Reconstruction Finance Corporation to send aid to banks that have ineligible assets. I'm quoting when I say ineligible assets. I don't know what Rothbard means by that, but apparently that's what was happening. They wanted more public works. They wanted more federal unemployment relief. They wanted lower tariffs. And most of these suggestions were followed by Hoover, except for the lower tariffs. And the lower tariffs was the only good suggestion that they made, which reminds me of kind of a corollary of Scott Horton's law, right? Scott Horton's law is that when a politician is talking and he makes a bunch of promises, if he wins, he will enact all of his worst promises and fail to enact all of his best promises. Well, this is the corollary, is that if you give a politician a variety of things to do, he will choose to do the bad things and not do the good things. So this is a nice example of that. There was a bunch of dissent, articles written by H. Parker Willis. He correctly blamed the old inflation for the gold outflow from the Federal Reserve's coffers, and he said that securities buying will make things worse. It will increase and aggregate malinvestments. And this is exactly what the Austrian school suggests. Gottfried von Haberler, I'm probably pronouncing it a little bit wrong, but he was a follower of Mises who came to the U.S. at that time, and he was probably the first person to present Austrian business cycle theory to America at that time. And there's a quote from him that I'm going to butcher, but he's basically complaining about the people, the economists and the people in government who are making all these self-serving recommendations for more spending on me. And he's like, oh, just build up these businesses again. They just need more funding. And he says, quacks disregard real dislocation. The full quote is in here a little bit later. Where will I find it? Actually, why not? Parker Willis, Haberler. Yeah, it is on page 315 on page 315 in the main text. So you can go find it there. I don't want to read the whole thing. Now we move on to the next section where we're finally back out of this inflation stuff. But now we're to something even more hilarious, which is Mr. Hoover's war on the stock market. So once again, Hoover continues to say really stupid things about the stock market. Basically that, oh man, the problems we're having are because of all these short sellers. And he's ignoring, of course, that for every short seller, there must be someone who's on the bull side of that. He resorts to the true values fallacy. Man, these stocks would be way higher if they were valued at their true values. But all these speculators are just saying that they're worthless. And no, there is no true value of a thing. The value of it is what the market says the value is. And, if you think it's higher than that, then go buy some and watch it go up, right? But in reality, this true values rhetoric is generally used to say that the value of things that are rightly devalued is higher than they are right now because of political or, ideological reasons. However, Hoover was a little bit successful here. He managed to bully the New York Stock Exchange into some restrictions on short sales. Moving on, we have the next section in the chapter called the Home Loan Bank System. Now, this passed in July of 1932. What it did is it discounted mortgages, or it provided discounted mortgages up to 50% of the value of the house or the property. Hoover wanted it to be 80%. You might remember, if you know anything about it, you know that 80% is like the level today at which you can get a mortgage without needing private mortgage insurance. So this is kind of a Hoover telling the future, but in the worst possible way, or in the most financially irresponsible possible way. We'll put it that way. It was passed in 1932, but it did most of its work in 1933. In 1932, it only did about $838,000 worth of mortgages, but that ballooned out to $94 million, so like a factor of 100 in 1933. Next section is called the bankruptcy law. There was a change to the bankruptcy law passed in 1932, which basically weakened the rights of creditors. It basically made it so that if there's someone who's defaulted, someone who's bankrupt, that a majority of creditors can force the minority of creditors to accept some kind of plan to pay off the debts, rather than actually taking the assets and auctioning them off or giving them to the creditors. And so there were a lot of people who didn't have anything like this in their contract, and a small number of creditors basically lost a lot of value because they're like, well, no, we want the assets. That's why we made the loan in the first place on these terms, because if he doesn't pay it off, we get the asset. That's the point. And they're like, no, you can't do that anymore. Now, in 1932, under Hoover, this was only applied to individuals. It would take FDR to apply it to corporations later. What this does, Rothbard notes, is it prevents liquidation, or at least slows the process. If these bankrupt companies or bankrupt individuals had to simply give up their assets and give them to people who would maybe do something useful with them, then that would be liquidation. That would get rid of the malinvestment. Instead, what's happening is that these people are plodding along, at kind of this reduced speed compared to the rest of the economy, and wasting resources with capital goods that could be better used elsewhere, and their business that they've already mismanaged and are continuing to mismanage hasn't been liquidated. Finally, we have the last part of the chapter, really short little bit here, the fight against immigration. So you may recall that Hoover created like this administrative rule that limited immigration. And in 1931, he was like, hey, Congress, make this thing legal, which is, I believe, an admission of guilt. But he kept it up. And in 1932, he asked for it again. He's like, hey, Congress, make my illegal immigration suspension legal. And, it did not pass. However, despite the fact that these administrative methods were not legal, they were mostly successful. And in fact, he bragged about the fact that he basically skirted the law in this one and managed to get away with illegal executive actions that he shouldn't have been able to take. So, that gives us the end of Chapter 11. As always, over on my blog, I will have my notes in a PDF form for you, and I will have all the references that I could find links to, which was most of them in this one. There was like one Barron's link that I just didn't even bother because Barron's was so stupid last time, or maybe it was the time before last. But anyway, Barron's archives suck. So yeah. Anyway, next time we will be doing Chapter 12, which is called "The Close of the Hoover Term," and it basically is the last chapter in the book. After this, there is a appendix, which talks about government and the national product between 1929 and 1932. And the appendix isn't lettered, so there might just be only one. Is there really only? Yeah, there's only one appendix. So what we'll probably do is we'll do Chapter 12 next week. And, man, it's only a couple of pages. Why don't we look at the appendix the week after that? That seems reasonable to me. So yeah, that's the plan. 2 more weeks. Chapters 12 and the appendix are both very short, so they won't require too much work on our part. But yeah, thanks for watching. Thanks for listening. We will have Chapter 12 up sometime next week, and we're almost done. One of Rothbard's great books, and this is one of those books that is like, applauded by even people who aren't, Austrian economists, as being a really good historical study. So yeah, that is that, and I will see you all. I'll probably have a short video up tomorrow. I'm not sure about what yet. I'll have to figure that out tonight, but yeah, that's what we've got. See you later.